Just going to the next question, looking for investment. This really wasn't a question, it was more of a statement. But Chris and I did talk about this one. And Chris, I'd like for you to take a stab at this. I think what we discussed was this isn't really a growth at all costs environment anymore. And we sort of kind of riffed on that. But curious how you think about that. If someone's looking for investment.
Yeah, I mean, the reality is that businesses that can deliver value to customers and do it in a way that they make money, those will always be valuable, but they don't always raise money from venture capital. So it's hard to start a business if you don't have any capital, if you don't have any money, but not every business is a venture capital backed business. And I think the approach, and if your only approach is to try to build a business that investors will like, quote unquote, you run into a problem where if what investors like changes, and it does change, you're going to have to change how you build your business. So the only thing that really works is if you focus on something that delivers value to customers, that solves a critical customer pain point, and to build a business in a way that it can make money. Because even venture capitalists want to see profits after a period of time. So that approach works no matter what the funding environment is. Try to solve a critical problem for customers who will pay for it. That's kind of the bottom line. And if you do that, then you can find funding in almost any environment.
You can see that too, yes. Since there's no longer growth at all cost environment, what advice would you give startups with regard to hiring in today's market? Scale back, essential positions only, stop hiring altogether. What are your thoughts?
Yeah, I don't think there's a blanket approach. It's all about controlling how much money you lose and minimizing that so that you can last with whatever cash you have for the next 18 to 24 months. In some businesses that are growing, if you don't hire it at all, then you're not going to be able to address the demand that you have from customers coming in. I mean, ultimately, you still want to build a business and you need employees to do that. It's really hard to do it by yourself. So I wouldn't say to everyone, hey, just don't hire anyone. It's a hiring freeze, or you should be laying people off. It all depends on what the current size of your business is relative to your revenue and where you see it going. I would just be very careful of hiring way ahead of the curve. If you think you need help with sales, it doesn't necessarily mean you need to hire a head of sales who can run an organization that's 3x the size that you have right now. In the past, if you had a lot of money, you try to hire way ahead of the curve. And I think the most important thing here is to try to hire in line with how you're growing, and not to anticipate crazy growth, because it may or may not come, and that becomes a risky proposition.
Might that be?
Yeah, I mean, it's sort of go to market and delivering whatever product or service that you have. I'm trying to generalize here, but if you don't have a product to deliver or service to deliver, then you're not going to get paid. So it's pretty simple. And if you don't have a way to get to customers to sell your service, then you're at a disadvantage. I mean, in a seed stage company, it's not uncommon for the CEO to be the head salesperson, talking, especially if it's an enterprise business where you're talking to potential customers and you're involved in every sale. That's a good way to understand what customers like and don't like about your company, building a relationship, all of those things. But the bottom line is, if you don't, you have to be able to build your product or service and deliver on it, and you have to be able to sell it. And so the most critical roles are the ones that do that. That doesn't necessarily mean you need a head of product or a VP of sales. It could be a more junior person. In fact, if you're a 5-person company, it seems a little odd that the other 4 people would all be VPs of something or other. Again, don't get ahead of yourself.
Or a CEO of one.
Yeah,
I've seen those too. No, that's helpful.
So if you want to raise money for a new product, and it's not related to your current business, then it would behoove you to set up a separate website, a separate legal entity to do so. Because if all you do is, if you're sending emails around from your current company, but it's about this new product, it's confusing to investors. I think the way to think about it is whoever you contact is going to have maybe 2 minutes to try to look at whatever it is you're trying to say to them. And so you want to make it as simple and as clean as possible, so they don't have to kind of make um, take hurdles to figure out what's going on. So if you're an existing entrepreneur and you have a new product that's really a new business, then set up a separate business or at least a separate website to focus on that.
You operated. The short answer is for most new companies, it seems as though a significant portion of the compensation comes via equity in the company and its future growth. I think, especially at the executive level, where people are incentivized to help the company perform long term. I've never seen like an earlier stage startup company, regardless of how well it was doing, significantly overcompensate its leadership team because most of the capital is being put back into the company to help it grow. And a large portion of their compensation comes via equity. Chris, what have you seen?
Yeah, the general trend for a venture capital backed company is that, first of all, the CEO's salary is the max. So whatever you're paying yourself as a CEO, you can't pay anyone else more than that. And conversely, you want to be, you don't want your directs to be paid a lot less than you are being paid. So you kind of set the bar with the CEO salary. And there is the idea, the general idea is as the company grows and gets bigger, the salary and benefits go up and the equity goes down as a percentage of the company, partially because of dilution, but partially because there are other people coming in and there's less risk associated with the company. However, in this particular instance, and Robert, maybe you want to elaborate a little bit. If you have a 6-figure monthly free cash flow, it doesn't sound like the kind of struggling startup that typically needs a lot of venture capital money. So this may be a situation where you could pay more in salary and benefits and less in equity because you can afford to pay more. In general, my approach to paying anyone at the last few companies I've been at is really to look at market data. And one source is called the VCECS. It's a Venture Capital Equity and Compensation Survey. If you have a venture capital partner you're working with, you can get access to it typically. And the way it works is you can look at the type of business, the location of the people, whether it's a founder or not founder, the stage of the business. There are all sorts of, it's a big spreadsheet that has a bunch of filters. And that gives you a sense of what the market is like. But essentially, you want to pay at market. The real question for this business, Robert, is whether it's a business with high risk and needs a lot of venture capital, or it's one that it's more traditional, and since you're making money, you could potentially pay more.
I mean, I would say that short answer and would be a lot of times earlier stage companies or even pre-seed companies aren't thinking about building companies that are meant to not just sustain themselves, but to be like institutional in nature. And a lot of times I'll see companies, they're doing a lot of things manually and they say, hey, I have this idea and I want to put together companies to sort of stand up this idea so I can make enough money to support myself. Where I think venture capital comes in is saying, how are you using technology to scale that? And how are you creating a business model such that that thing that you're doing can be repeated over and over and over again with fewer and fewer inputs? So I think with a lot of companies that are developing within sort of accelerators around the country, and it's not just specific to Oklahoma City, it's really helping founders get to that transition point of thinking a little bit bigger beyond just building something that can support themselves or that they can run individually, but more so thinking about how do I build out an institution such that it can operate and stand alone at scale. And that's really how venture capital, like how I think about companies is, can that company get to a point to where the founder is no longer needed and they can rely on their team such they can build out a corporate organization. And I think that uh, raising venture capital, when we're looking at teams, that's kind of what we're looking for is like, are they thinking like that to begin with? And if they're not, it may just be a company that is perfectly fine. They'll make money, they can support themselves. There's absolutely nothing wrong with those businesses. But I like to see that sort of scale type thinking with the companies that I'm looking for. Chris, any
Yeah,
thoughts on that?
yeah. The only thing I'd add is just to reinforce this idea, not every company needs to have venture capital backing. Venture capital is meant for high risk and high return. Typical venture capital company is trying to look at a 10x return on their investment because only 20% of investments, if you're good, only 20% of your investments bring back the money you put in. So there's a kind of expectation of that. And so in order to get that kind of return, you're looking for dramatic growth that can happen in a scalable way, meaning as you grow, you don't have to hire as many people. There's, as Kevin mentioned, you use technology to kind of scale the business. So there are a lot of great businesses that don't use or don't need venture capital. And I wouldn't be here today if my dad didn't start his electrical business and he bootstrapped it, which is what most people do and did to do his, electrical contracting business. That's what he did. It wasn't venture backed, and he supported 3 kids going to college, and he's just fine. So not everything has to be venture capital backed. And it's a certain type of profile that venture capital companies are looking for. And so it is a mindset. It's also like, how big is the opportunity? How scalable is this? That's the thing that makes something venture backable, to use your term, Kristen.
And I made my last point, and I'll get to Sarah's question next, is I feel like, and Chris, you and I have talked about this behind the scenes quite a bit, that it seems like so many people and founders are being trained on how to raise capital versus how to operate a company. And I think that there's this mentality that there's something wrong with if you don't raise venture capital. To Chris's point, you can build a very good business and not raise VC and live a good life. So I just wanted to throw that out there as having a great company that you're operating is still a success.
I can start. So financial projections are difficult, even for an established company. People get it wrong. Layoffs happen really because someone thought they were going to need all those people, and they a year later they figured out they couldn't afford them. So that's one element. There's always a degree to risk in financial projections, no matter how big the company. And in a smaller company, the risk is higher. The other piece is, I would build on the idea that vision without execution is hallucination, meaning that a financial projection sort of reflects where you think the company will go. That's your vision. But unless you have a very clear and concrete plan behind it, doesn't mean anything. And so having built many financial models as an analyst at Bain and in other places, it's all based on the assumptions. So you want to understand, what are the assumptions that are going into this, and what basis do they have for assuming this many customers over this period of time? Do they have a proven model of how they acquire customers or how they get revenue? Are they getting even just revenue per customer? Sometimes that's an assumption. They don't even know how much money the average revenue would be. So I would dig into the assumptions just to understand, is there actual fact in terms of previous experience or history, or what else is driving the assumptions that are in there in order to understand those projections? Because we've all done it. You can put together financial projections, but unless you understand exactly how you get to those numbers, they don't really mean much.
Okay. I would say absolutely. Just for everyone's sort of edification, within the venture capital industry, some of the best opportunities that we see come from other groups where they're taking these companies through a due diligence process and vetting their team, their strategy, et cetera. And I look at relationships with other VCs as being very valuable because they might look at deals that uh, I want to see, but don't fit their strategy, and vice versa. So, short answer is, if you have those situations come up, James, or anyone else on this phone call, definitely put us in touch with those other venture capital firms. So, I guess the question is like, what is sort of that inflection point or that tipping point to where traction is achieved? Um, this is a very specific question, but just in general, my thoughts were there should be enough history to help understand your sales cycle and your customer acquisition costs, your churn, et cetera. And I would even I'm in this particular situation, I'd be less concerned about sort of the number of paying subscribers, which is certainly important. You need that to make money. But if it's depending on the stage of the company, definitely the growth rate of how many people are signing up is important as well. Because there's in my mind, the standard metric for conversion from non-paying to paying, there are industry numbers for what that should be, but I don't know. This is a very specific and difficult question to answer because I think it depends on how does this compare to the industry, et cetera. I don't know, Chris, if you have a different thought here, but
Yeah.
that's kind of how I think about it.
Each investor will measure traction differently, and at each stage, they'll look for different guide points in terms of whether or not there's traction. So at the earliest stages, at a seed or pre-seed stage, you're looking at, is the idea a big one in terms of its potential, and is this a good team? Because the team will go through a bunch of ups and downs, and will probably learn a few things and maybe change direction. And so is this a team that's resilient and adaptable? In this particular business, specifically with a subscription business, again, how much revenue you need from subscription before it's big enough really depends on the investor. But they'll look at things like annual recurring revenue. But the most important thing, the little tidbit that I got from the question, is that you've converted from a marketplace to paid subscription. Subscription model is great because there's money coming in every month. But the key dynamic of a subscription business is retention. So Kevin talked about the first piece of it as how many people are coming in, how quickly are you signing up subscribers? The other piece of it is how many are you losing? Because the reality of any subscription business, even Netflix or the strongest subscription businesses, is that customers don't last forever. They don't subscribe forever. And so you want to understand your retention rate, or how many people leave after a period of 30 days, 60 days, 90 days, and so forth. And once you understand that dynamic, and that takes time, obviously, you have to wait months to see exactly what your retention is. And then investors want to see, okay, are you improving retention? So the people who started 2 months ago, are they being retained at a higher level than the people who started 6 months ago? So all of that takes time to kind of build up that data to figure out what your retention rate is. And once you understand the retention rate, you can understand the lifetime value of that subscriber, which gives you a sense of what the long-term prospects are for the business. So that may be a particular issue in this particular case if you just switch to subscription models. Subscription models need time in order to understand retention, because that's the most important piece of a subscription model.
Hence the history. And brings up an interesting point back to Sarah's thing about projections. Had a number of meetings with a founder, and they got their pitch deck completed. And when I got to their financial projections page, I noticed hockey stick growth, things were great. But then I looked a little deeper. They didn't assume any churn with any customers at all. And I thought, I'm like, this is a subscription business. There's going to be churn. And then I went back and I told the founder this. They redid the model and the assumptions looked, or the projections looked completely different, not as great. So it told me, one, they don't understand their business. They don't understand this part of it. So I think, Sarah, as you look through these models, look for those little things that sort of point out, does this person really understand their business? So
Just
anyway.
maybe the second part of that question is really asking what types of companies are you going to be most interested in investing in? I think you do have a kind of investment thesis of the types of companies that you're interested in. Maybe we could share that.
Yeah, I mean, I certainly like certain categories, right? I love companies in the financial services, fintech industry. I love companies that are building tools that make commerce easier, faster, less expensive, more efficient, et cetera. And then I really like companies that are creating technologies that make the workplace better, kind of the future of work category, whether that's incentivizing employees and enhancing employee retention, making it easier for employees and employers to communicate with one another, things that are making work easier. The pandemic really accelerated growth in these three categories and sort of revealed the need for more tools and services within these spaces. But that does not mean that there are companies outside of those three categories that we won't look at. There are some really strong companies that are technology driven that come across the table, and there's a few that Chris and I are looking at now that aren't in any of those categories. So at the high level, seed stage companies that have a reasonable valuation for us and would be anywhere between 10 to 20 million at the high end, who are raising $1 to $5 million seed rounds, and they have I wouldn't say an established team, but they have a team. They are beyond the proof of concept phase, and they're looking for capital, but they're also looking for people who want to provide additional value with things from us being able to provide operational advice and connections to people within our network, et cetera. So I think that's sort of a founder archetype. And I don't know if that answers that question in general, because I will look at all deals. We will look at all deals, but categorically, those are the ones that have been defined for right now. And as far as due diligence, at the high level, we're looking for founder market fit, making sure there's a large addressable market, product market fit, that they have some sales traction, and then business model longevity. Like, can these companies continue to persist through multiple cycles? And one way that I gauge that is, are they able to make repeat sales to their same customers? Is this a product that has more than one dimension? Can it expand? Can they do more with that? When I think about the companies within the portfolio now, and although there are only three, characteristically, each one of those companies are building technology that have the ability to land and expand and to do more than one thing for a particular customer. That's critically important for me. And back to one of Chris's questions, like I've seen a ton of founders who they have a product and that's it. And sometimes that's not really a company. It might be something that they can license or sell to somebody else. But to be sort of venture back, there has to be a demonstration of growth and the ability to expand and scale at in a significant way. So just my 2 cents on that, Chris. I don't know if you want to add anything to this.
No, I think that's all good. I mean, for me, the thing I always focus on is our customers. Are customers happy with your service? The existing ones that you have, or potential customers, what are they looking for? Are you solving a real customer need, a customer pain point?
To you, what was the most beneficial investor relationship that you had, and what about that made it beneficial? And this may have been whenever you were leading some of the tech companies that you led. And then the second part of that question is, uh, what should startup founders look for and avoid when they're talking to investors, just to make sure that they don't accept a check from someone and that come with a lot of attachments where onerous obligations associated with it.
Yeah. So as I mentioned at the beginning, my experiences as an operator, after spending a bunch of years at eBay, 11 years at eBay with the last 8 running StubHub, I was an entrepreneur in residence at Benchmark Capital, another venture capital firm. I ran a startup called Vivino, which is a venture-backed wine app. And I've worked with a bunch of investors on boards and other things. So as an operator, as a CEO, the thing you want most from your investor after the money, because if they don't bring you money, they're not an investor, but after the money, the most important thing they can bring you is advice and support. Being a CEO is a difficult job. Having a board of directors is a huge pain in the ass because you have a group of people telling you a variety of things. Sometimes they don't all agree with each other. And you have to kind of please them. So it's like having 5 bosses or 6 bosses, or God forbid, 10 bosses, as opposed to 1. So you want an investor who, first of all, you want to be able to maintain a relationship with that investor for the next 10 years. This is something I learned at Benchmark. When they look at entrepreneurs, they want to be able to say, this is someone I can work with for the next 10 years. This is a long haul experience, and it's someone you want to be able to spend a bunch of time with. And that, comes down to personality and fit, and it's not something I could easily characterize. But when you're talking to investors, you have to ask yourself, is this someone I want to work with for the next 10 years? The other aspect of it is, are they going to be able to help you and give you advice or support when you need it? Support can come in a variety of ways. One can be in helping your business by connecting you to potential customers, to potential partners, to potential employees. Guys like Bill Gurley at Benchmark, Bill hustled. I mean, he was very busy looking for senior employees at Uber when I was there in 2016. He spent a lot of time looking for senior talent, in addition to talking to companies and sitting on boards and all that stuff. So he brought value to the equation. The other potential area I mentioned, partners, potential partners or customers. The other is just operating expertise. A lot of people in the venture community have no operating experience. They've never worked in a company and operated a company. And believe me, it's extremely frustrating with some of those folks. But there are two ways where a non-operator can be helpful. Well, one way where a non-operator can be helpful. If they've been on a bunch of boards and have seen a bunch of different companies operate, they can have this industry experience that can be helpful to you, even if they weren't the operators. But they could connect you to the operators because they've seen it. And again, a guy like Bill Gurley, he was really good at that. Ideally, though, you have an investor who has been an operator, and maybe even specifically in the type of business that you have, so that their experience is directly relevant to what you're doing. Most of the companies that I advise are in businesses where I have some type of experience, and that's where I can add value because I've done something similar, and where my experience can be analogous and can be used to help them think through a problem. But that's ideally what you want. Ultimately, you want someone you can talk to, you're going to be able to talk to and go to for advice and have a meaningful conversation with for the next 10 years. That's sort of the summary that I would put together. I would say, first of all, the best investors are those who have enough security in themselves that they realize they could be wrong. They're not always right. And I say that because with some investors, there's certain arrogance that they have all the answers because they have the money. There's a kind of power game, and a power game isn't based on actual knowledge. The other things I'd say to you is remember that you always know much less about the companies you invest in than the people operating it. And if you don't trust those people, then you have to not invest or or move them out. But ultimately, you can't run the company. They have to run it. And so you are in a support role. You're not in a command role. So the next step of that is like, how do you add value? And it gets to understanding what are the critical questions or problems that the entrepreneur has. Maybe they have a problem with hiring. Maybe they have a problem with sales. Maybe they have a problem with product development. It's understanding that and asking them what they need as opposed to imposing your will upon them. This is the type of stuff I tell myself with my kids who are 18 and 20. So it's similar dynamic. Sometimes as an investor, you're like, oh, fuck, I know exactly what these guys need. But if you try to kind of force it on them, it ruins the dynamic. So you can suggest things gently, but I think if you're responsive to their needs and can help them in their needs, then they're going to be a lot more open to hearing from you about things that they hadn't brought up themselves, things that you see. So again, it was those things that I talked about. It could be finding partners, could be finding customers, could be finding employees. But the way to think about it is that you have a job. Your job isn't just to sit on the board. Being a board member or being an investor is a job, and it's a job for that company. You're doing a service for that company. And so the best thing you can do is ask the CEO, what service can you provide for that company to be a valuable member of the company and a valuable contributor to the company?
Yeah, and Nita, I'll add to that by saying my mentality with investing in any company is that, again, the check is fungible. What I mean by that is it's just a commodity. And I tell every single one of them that I don't know specifically what it is that they're going to need, but whatever they need that I can do, I will. And for every single company, it's been either I've served as a reference talking to other people who are looking to invest with them. With another company, it could be, hey, I need help with introductions to downstream investors for my next funding round. I've done that. With another company, it's been, hey, we need help reading over some marketing material that we're putting out, and your expertise in this would be helpful. Or we have a job description that we're putting out. Can you look over this? Just, it's like whatever it is. As Chris is saying, I feel like my job beyond the investment is to try to help that company succeed with whatever it is that they're doing that I can do within reason. And I think that's the sort of mentality. It's like I'm in a position of service and building out a platform to where if a founder needs help with their sales and marketing, maybe I introduce them to someone like that. If it's operating experience, maybe they'll talk to Chris. If it's something with their leadership team and they need to recruit talent, how can I help source that for them? Or they need the introduction to whoever. My position is one to serve. And I think that that's what founders will sort of feel from you as you're working with them, whether you have operating experience or not. If not, one of the questions that came in, how do you start a VC firm? One, you have to be out of your mind. I'm just kidding. Because it is really hard. But a venture capital firm is no different than, it's certainly different, but it's just it's like a company, right? You have to be entrepreneurial to do it, and you have to go through a process. For me, in starting Serac Ventures, and I was a partner at another venture, actually a venture capital fund of funds, and just understanding operationally how venture capital funds work. You have the general partnership, and then you have your limited partners who are your customers, and then you have your entrepreneurs or founders. And I hate to say it like this, but your founders are your product. And to the degree that you can build a firm that is cultivating and finding the best product, you're going to provide a service to your customers, which are your limited partners, your investors. And the objective with the VC firm is to multiply their money. And to the extent you're successful doing that, you can raise another fund. But starting a fund is really just another company. It's just the medium is the founders and the industry. Now, the founders and this particular type of work. So there's a lot more to that. that if someone's like serious about wanting to start their own venture capital firm, but that'll have to be a separate conversation. What did Erica say? Oh yeah, know how to defy the laws of gravity like venture-backed entrepreneurs. I totally agree with that statement because it is kind of like that.
Yeah, and Kristen pointed out it's all sales, meaning you're basically you have to go to limited partners who will invest in your fund, and you're selling them on the vision of the fund and what you're doing. And at the same time, you have to convince entrepreneurs that you're the right investor for them. So it's sales on both sides.
And I guess it goes to meeting, etc. And I'll say maybe short answer to that is I have fortunately, knock on wood, never really had much difficulty getting an entrepreneur to respond. Uh, if they're if I'm genuine in my interest in wanting to learn about what they're building. Ideally, I'd like to talk to founders when they're not raising capital so that they're more relaxed about telling me what's really going on. But I would say that the biggest thing is people don't follow up. I think that if a founder's reaching out to me or I'm reaching out to a founder and it's someone I really want to talk to, I'll follow up multiple times. But just until they tell me no, I'll continue to follow up. But you'd be surprised at how few people actually do that. So I would say just be persistent.
When I was at Benchmark, I reached out to some folks, and sometimes they're like, "No, we're good. Don't need money. Don't want to talk." And the impression I got was that they were very wary of talking to an investor because it would take up their time. It would they might divulge some kind of secret, and they didn't, that would somehow help a competitor, that type of thing. So I think a lot of entrepreneurs can be a little cagey around investors reaching out to them if they're not looking to raise money.
Yeah, it should be, but this was actually a lot of fun. I thoroughly enjoyed it. And if you guys have any questions about Serac Ventures or you want to point investors or founders to us, certainly reach out. I think our emails are on the Serac Ventures website. But thank you all so much for your questions and for joining us today. Thanks, everybody.
Bye, everyone.
Bye bye.